Now, just piggybacking off of what we talked about, we just wanted to just highlight one more thing with, again, the keeping the eye on the core goods component of CPI, which is, it's in that disinflation mode. And it's when looking at the 6-month annualized, you get an idea. But the pivot that we keep talking about is core goods and services. And service pricing and service inflation actually is shifting higher and continues to shift higher. But goods is starting to roll over a bit. But why is that? And we want to look at some of the shifts in the way people are consuming and how that results in the consumer sales. So this is, I think, a really important piece when you look at some of the averages. So U.S. retail sales increased 3.9% over the last year, which is the lowest growth rate since May of 2020 and below the historical average of 4.8%. After adjusting for inflation, the picture deteriorates a bit with real retail sales declining 2.3% over the last year, the 5th consecutive year-on-year decline. So that's the negative take on it, where if you adjust things, you look at it on averages, you get some of this, some of the headline number doesn't look as good. But again, we want to look at the negative, and we also want to look at how this was positive. So one of the key pieces going forward was the ultra low savings rate and the ultra high credit card spend. So when you look in January, total credit and debit card spending per household based on Bank of America internal data went higher. So as they quoted, we have seen signs of a strengthening in consumer spending at the start of this year. Credit and debit card spending per household rose 5.1% year on year in January compared to 2.2% year on year. So if you think about January, there were lots of sales, there was a lot of inventory, and you saw people take advantage of it. And the question is now, what happens in February? Where is this going to trend? And we want to look at, was the spending for good reasons, or was it because prices continued to accelerate higher? When you look at consumer credit outstanding, people are obviously using more and more credit, as you saw with Bank of America, and U.S. personal savings rates have flatlined. But again, they're not going up much. But and this is why, just as the running joke with economics goes, where every economist has called 5 of the last 2 recessions, everybody has called the death of the consumer 100 times and it's happened 0. So, it's important to look at where is the consumer going and what is that trend going to look like, because we saw the deceleration that we've been talking about. You saw a bit of a flat line. Now you saw a nice spike, but is this really a pivot, or is it just kind of a reprieve before we see the continuous decline? So delinquency rates on credit card loans, all commercial banks. So retail sales were robust in January, spiking 3.3% month on month. And when you look at the trend, it still is going above trend. But what does that mean when you look at delinquency rates are increasing and commercial bank interest rates on credit cards are now at, as we've been saying, over 19.3%? Which is the highest they've ever been, going back to, I think the last time they were near this was 1985, and we crossed into a new record. So as that goes up, well, you're seeing delinquency rates also go up. So yes, people are still spending, they use credit cards, but they're also not paying that credit card now. And when does that cross over and become a bigger problem? As we've been saying, we think it has already happened and is happening now. But what drove this? And again, there's good movements and bad movements. So when you look at motor vehicles and parts was a big driver, and you can see how over the last year and a half, motor vehicle and parts has been super lumpy. And it's all because of the massive moves in the numbers. But again, as somebody who, people watching this, how often do you buy a used car? How often do you buy a new car? How often do you have to get that car fixed? So when you look at the month, it's like, all right, well, did people take advantage of January deals? Did people wait to the January deals? Because, that's usually when you get some really great opportunities. You had some inventories coming back in, so you had used car services coming through. And then food services and drinking. You had a huge surge in food service and drinking spending. But did you get more for it, Or was this because prices have surged to such a level, as we showed in the previous segment? Hospitality and leisure and hospitality have seen a massive increase again in wage increases and that stickiness, which we keep talking about. Some of the other key pieces like food and beverage was negligible. Gas stations was negligible. So the two biggest components, are lumpy. And that's why when we look at the retail sales, and again, as you can see, even if you take away motor vehicles and food services, you're still positive. So we are by no means saying that if you take away this, like, the New York Times likes to do, or some of these others like to do, where it's like, well, if you take away all of these high things, there is no inflation. It's like, well, but people spend on that. So you look at this, it's like, well, people still spend money on that. And it's like, absolutely. And we're saying, even if you take out these high spending items that are very lumpy, we're still positive. There are still positive sales. That is still a good thing when you look at the economy. But when you look at from the Fed's perspective, well, why are we pivoting? Like, why would we pivot? Like, clearly there's still more to go. Clearly there's still spending. So the economy can still tolerate, the consumer can still tolerate rate increases. And again, that's some of the back and forth where there's bullish sides, there's bearish sides, and then there's the truth. And, we like to think that the truth is it was still a good number and it's still going to send rates higher and it's not going to cause a pivot. That's our take. Whether you think that is good or bad is up to you, but that is the long and short of it, where retail sales came in stronger than expected. They were still good. Fed's still going up. So now when you look at not much budging at all for the CPI services, less energy, 6-month annualized percent gain moved higher in January to 7.3%, which is still among the fastest in decades, which is, again, when you look at some of that activity, well, your prices are still going up. So if you want to maintain just same level of comfort, you're spending more. And that's why when you start adjusting things for inflation, you get some of that pressure point. While net percent of small business raising prices fell in January, net percent planning to raise them in the next 3 months rose because, again, you have that wage backdrop. You have some of these price increases, and the consumer can clearly still tolerate some of that. So, again, you're still seeing that back and forth where there's good and bad in everything. Just as nothing is black and white, there's always that gray. So U.S. inflation eases in some regions, but you have to think about where. Like when you look at New York, you look at some of these other places, like they were already elevated. You look at some of the places in the Midwest, you had this huge surge because you had a lot of people moving in. Now things are backing back off. So annual inflation in Montana state region came in at 7.2% in Jan, still hottest among all regions and at odds with inflation in South Atlantic, which saw the largest drop in annual rate of inflation. So when you look at the rate has come down in some areas because, well, when you look at it, some of these places already had really high inflation. Like I was talking to someone the other day when people were talking about like New York and New York home prices, and it's like, well, New York home prices never really went down. So when you saw when they kind of moved up with inflation and asset prices, they moved to a higher level, but it's not like it exploded. It's not like it went to these different levels. So again, there's that pressure where on a gross level, New York is still super expensive to buy a home, but when you look at it on a percentage level, it didn't have the same increase, which is why it still sucks to live here. Single most important problem is still inflation. Quality of labor obviously still there. So again, that's where we're going to continue to see that inflationary piece, and that's not going anywhere anytime soon. But poor sales is going to be the one to watch. And coming back to retail sales, well, the small business is telling you that they're still okay. There's not a big concern about retail sales. And again, that's more of that leading indicator that we like to look at. Now, February Empire Manufacturing Index improved to negative 5.8 versus the estimate of negative 18. A very different story than Philly, which got much worse. Both still in contraction, but some showing a bounce, some still showing a degradation. But again, the trend is still in contraction. You're still getting lower lows. And again, that's why we talked. The trend is still moving in the wrong direction. New orders better, but still contracting. Work week worsened. Prices paid moved higher. And again, Coming back to retail sales were strong, so prices paid continue to move up. And you look at the pivot, you look at the recovery of funds. There's still an opportunity to raise prices because they're going to do this until the consumer finally yields. And at this point, they're still seeing that there's an opportunity here. Employment dipped to the lowest since the pandemic began. 6-month outlook improved. But again, like the inner workings of the Empire's data still showed a problem, especially against the Philly side. So now when we start looking at U.S. real wages, inflation adjusted weekly earnings growth remains negative, but has risen to negative 1.5%. Best rate since November 2021, but still negative. So when you look at spending, you're still, if you want to keep your life the same, you're increasing credit card spending, you're increasing the credit usage, you're pulling from savings because you just don't have the backstop not to. Now, U.S. manufacturing output is trending lower, down 1.4% in the latest 3 months versus the prior 3 months, excluding COVID. Steepest rate of decline since July of 2009, which corresponds with the signal of a worrying downtrend. Biggest question is whether the January U.S. manufacturing output gain month-on-month basis is just temporary noise, or if this is a genuine sign. As we showed in some of the data sets, it's still down. It's just, nothing dies in a straight line. There's always lumpiness. You saw retail sales picked up. Is that a changing trend, or is it just kind of a bounce until we continue? And again, that's where we look at these trends, and right now, we don't see a trend change. We don't see it collapsing. As we've been saying from the beginning, retail sales is not going to collapse. It will go into contraction, but it's not going to collapse. That's not the U.S. consumer. We love to spend. But the question is it going to grow, and is it going to be a positive or negative contribution to GDP? And we think it's going to be a negative contribution to GDP, just as this will as well. Overall, consumer confidence has started to climb off the lows. Individuals have gotten increasingly comfortable with stocks again. So again, some of that movement to the upside in terms of pricing. Excuse me. Consumer sentiment is bouncing back from its low point of the current cycle, but feelings around unemployment are still dour, with the survey saying 42% of consumers expect to see higher unemployment within the year. And again, it kind of meets with where things can kind of pause, then continue lower. And we just get, and again, that's why we always talk about how you can spin anything right now, bullish and bearish, because we're in such a flux and it's such a pivot point where we're either going to kind of pivot higher, pivot a little bit lower. Typically some of these data sets don't really stay flat. They can pause for a moment, but then they usually continue a specific trend. And one of the things is we do think it continues a negative trend as the rates continue to go up. And then when you look at underlying, the retail sales came in at 3% month over month versus the estimate of negative 2% of positive 2%. The prior month was revised to negative 0.9. Sales ex autos came in at 2.3% versus the estimate of 0.9. And then in the control group, came in at 1.7% versus the estimate of 1%. So again, as we said, good across the board. But then when you start looking at, open table seated diners, monthly change versus 2019, you saw a big drop. Now, you did see it get better for Valentine's Day, as we showed in the EIA show, but there has been a negative trend that things have pivoted down, and there's that clear drop. And that's where we do think that retail sales on the food front is going to start to really catch up and weaken as we get into Feb. Now, when you look at U.S. retail sales, and then U.S. real retail sales, you get an idea of just that level that we were talking about previously. Now, wage growth starting to ease for the lowest earning quartile, but still ticking higher for the highest. Now, when you look back at prices paid, prices received, that again, you're starting to see kind of this waffling back and forth. Nothing is showing that we're going to get a nice big correction in wages, as real wages are still negative. So if real wages are still negative, inflation is actually pivoting higher again. Well, how am I going to cut wages further? And this comes back to the wage spiral that we've been talking about. Median wage growth as tracked by Atlanta Fed came in at 6.1% in Jan, same rate as in December, in contrast with average hourly earnings, which continued to decelerate. But going back through to 1997, we're still at some of the highest we've ever been, which again creates more of this pressure on why the Fed is going to continue what it's doing. February update from University of Michigan shows inflation expectations for year ahead ticked higher. Again, we don't see that adjusting as you look at the sentiment index and the consumer expectations. Expectations came in well below estimates, and that's where, again, holding at those lows where we don't see too much of a pivot. When you look at wage growth for job switchers, continues to ease. Growth is off peak for job stayers. But based on this, you're still going to switch. It's just you're not getting as much. And when you look at the small business data, they're trying to not raise wages to the same degree. The question is, does that stick? And based on where inflation is, where real wages are, it's going to be difficult. CEO confidence index, as measured by the conference board, ticked higher in Q1. Still pessimistic in level terms, but again, and as we've said, you're still at recessionary levels, and it's hard to continuously go down because there are bright spots. You might cut some capex, you might get a good deal on something within your business that's going to carry you through the next 6 months, so you feel a bit better about it. Again, all of these things matter when you look at how, but it's still not in an expansionary territory. Consumption to slow in February and March based on real PCE, nominal PCE, just looking at some of the research here. And again, we agree with that take, obviously, and the reason why is when you look at inventory sales ratio, there's a lot of inventory out there, sales are slowing, and that's again showing some of that softness on the retail side going forward. Industrial production unchanged in January, and as we've said, it rolls and then it starts to accelerate to the downside. Factory production slightly better, and again, that's where we get some of that mixed data sets where Philly's showing weakness, Empire showing a bit more weakness, and again, when you look at manufacturing, it's just kind of waffling here, but we do think that there's going to be that underlying slowdown. Consumer index fell much faster relative to its 2-year average last year versus the drop of the consumer confidence. And then the recent improvement in the former has been rapid, though, again, closing the gap. And that's what we've been talking about. And, likening back to the beginning of this is the gap closes. And that's what we've been saying. It's not that the University of Michigan was right and Conference Board was wrong or vice versa. It's that they're both wrong. And they're somewhere in the middle, but somewhere in the middle is still contraction, is still a problem for future spending, future investment. And then when you're worth noting, if December marked a low, the prospective buyer traffic, given a strong bounce since then, prior major troughs happened in December of 1990, October 01, December 08, April 2020. But what we see is more of just a sideline move and it's going to be something closer to 09 where, you don't continue to go down or collapse, but you kind of find this comfort level. And again, I think that sideways move is likely, especially when you look at some of the shifts. So sharp improvement in the share of consumers saying home buying conditions are bad due to prices and high interest rates. Still bad in level terms, but an improvement. And again, it's hard to continuously get worse. Home sale to list ratios have declined quite dramatically. Median ratio is 98.8%, with Philly and Chicago falling slightly below. Boston is highest. So again, the people are not listing their homes. They're looking at this saying, well, I don't want to sell at these prices going down. So there's that standoff between seller and buyer, and it's going to take time to really kind of correct that or see who wins. Now, strong bounce for the home builder sentiment, up to 42 versus 37. All components moved higher with a notable increase in future sales, and it's nice to see some of that. But January housing starts came in at negative 4.5% versus the estimate of 2%. Building permits came in at plus 0.1 versus the estimate of negative 1%. So again, you're kind of seeing some of these different trends for both in level terms continue to weaken, and that's where it's like it's hard to go down in everything, so you have to have a little bit of a bounce. MBA purchase index, the lowest it's been going back to 2014. Purchase, for the week, it's typically you start to see an acceleration as we come into spring, come out of winter, and you're just not seeing it. Again, that's why there's some of this overhang, and it's hard to continue to get worse. It's just who blinks first? Does the buyer go, all right, I'll pay the higher price? Or does the seller recognize that, look, based on where interest rates are, that home prices have to come down? And it comes down to, again, demographics, asset values, which is why when the Fed looks at this, there's nothing that says the Fed's going to pivot. There's still so much froth in the market in asset prices. Rates are going to continue to go higher, which is going to put more pressure on consumers, reduce retail consumption, and that's why we do see that moving lower. So that's what we have for you on the U.S. In the next segment, we're going to go deeper into Europe and what's happening in that neck of the woods.